In this section, I'm going to cover another example of loan amortization with you, which is probably a bit more realistic and more representative of the kind of situations that you may encounter out there in the world. How do I mean? Let's consider this example. So let's suppose that you have just arranged to purchase a $500,000 house. Hey, congratulations. You're going to be making a 20% down payment on it. This is the money that you are putting in. Of course, if you're only putting in 20%, the rest of the 80% needs to be coming from somewhere. And so the rest of the 80% is going to be in the form of a loan. Now, the term that you will encounter out there is called mortgage. So that you'll hear something like the mortgage requires you to make equal monthly payments. Mortgage is just a fancy way of saying that you're getting a loan to buy a house. And in this case, the loan amount is basically 80% of the purchase price, which is $500,000. So the amount of loan that you're getting is basically $400,000. So when it says mortgage, just think loan. It's a loan in the real estate, basically, or a loan to buy a house. So you're getting a loan of $400,000 today, and the financial intermediary or the bank basically comes to you and says, look, we want you to make monthly payments, fixed monthly payments over the next 30 years. And the first payment that you have to make is 1 month from today. Now, this is a little bit unrealistic because typically these kind of loans require you to make the first payment today or starting immediately. We'll tackle that in a bit. Let's assume for the time being that your first payment is going to be 1 month from the time that you get the loan. You're told that the APR, the annual interest rate, is 6%, so that's the mortgage rate, but it's being compounded monthly. And so I want you to tackle two questions. First, how much would your monthly payment be in this situation? And then B, which is probably a little bit more realistic, how would your answer change right over here if the payments were due at the beginning of each month, which, like I said, is a little bit more realistic? What if the banks say, look, you have to make your first payment starting today? How would that change things? Turns out it will. But let's take it one step at a time. So the first thing that I recommend is that you draw a timeline. And here, your timeline would be best represented if you think about it in terms of months, because the payments that you're going to be making are going to be on a monthly basis. And so the way you want to draw your timeline is something like this, where you say, okay, this is where I am today. This is 1 month from now. This is 2 months from now. And if you keep on going like this, ultimately, right, so hope this is keeps on going, and ultimately you're going to arrive at 359 months, and then finally the end of 360 months. Why am I going as far as 360? Because, as we said, the mortgage is, or the loan is for 30 years. There are 12 months in 1 year, so 360 is basically 30 years. So 30 years times 12 months. So in 30 years, you're going to have 360 months. So basically, the mortgage requires you to make one payment at the end of the first month, second month, so on and so forth. Then one at the end of 359th month, and finally, this is the end of the 30th year. So these are the payments that you will be making. And the loan that you have received today from the bank, we just argued that that's a $400,000 loan. And so the question is, how do you determine this monthly payment? Now, this looks very much like an annuity because you're going to be making constant payments at regular intervals for a fixed number of months. The one thing that is missing here is that what is the interest rate? And this is very, very important. While the interest rate is given to you as 6%, this is annual. This is annual. And your timeline is in terms of months. So you need to convert your annual rate into a monthly rate, which is kind of simple. You just take the 6% and you divide it by divided by 12, basically 0.5%. And so now we have talked about this before, that if you're trying to then determine these payments, basically from the bank's perspective, the present value of these payments needs to be equal to 400,000. So if you were to solve this, you'd basically say 400,000 should be equal to C, which is the payment. And then you say 1 minus 1 over 1.005, which is basically 1 plus 0.5%. We're going to raise it to the power 360. And then we're going to divide all of that by 0.005, which is 0.5%. And so the idea here is that we're trying to solve for C. And when you will find that C will come out to 2398.2. So about a roughly $2,400 monthly payment. Again, this payment is designed in such a way that it will over time take care of the interest expense and also the principal amount. So this would be the answer to the first part of this question. How much is your monthly payment going to be? It's going to be 2398.2. Now, the second question that we asked ourselves was, how would your answer change if the payments were due at the beginning of each month? Whenever you see a term like this, think annuity due, because what we're really saying is that, look, what if the first cash flow payment that you have to make is right over here? The first C is over here. The second one is over here. The third one is over here. Keep on going, and the last one is going to be over here. There's going to be nothing over here. Nothing over here, right? So this C, while existed in an ordinary annuity, in an annuity due, in which the first payment is going to be at the beginning, you will have your last payment at the end of 359th month, or at the beginning of the 360th month. This is often a source of confusion for students. Students often think, oh, with an annuity due, you have, one extra payment. No, you're still going to make 360 payments over 360 months. It's just that they just get shifted back 1 month. And so we have seen in the past that the present value of an annuity due formula basically takes all of this and you just multiply by 1 plus R. So put in other words, the way you're going to approach this is you're going to say 400,000 needs to be equal to now C, and now you'd again do 1 minus 1 over 1.005 raised to the power 360. All of this the same as before. You divide by 0.005 again, but with an annuity due formula, we know that all of this basically gets multiplied in addition to 1 plus R, which in this case would be 1.005. And so now you again need to solve for C. Notice that when this term wasn't there, C was solved as 400,000 divided by all of this guy, right? Which gave us 2398. Now you're saying you need to just take this term, 2398, and divide it additionally by 1.005. So you can just take a shortcut here and say, look, C is basically going to be equal to 2398.2, and then you just divide it by 1 plus R, so 1.005, which if you will do, will give you about 2386, so 2386.27. Before you were even going into this calculation, you should have expected that your monthly payment is going to be lower here in this situation. With an annuity due, your monthly payments are going to be lower. Why? because when you are waiting, if you take on a loan of $400,000 and you wait just 1 month to make your first payment, well, guess what? You have accrued some interest, and now you need to make a somewhat of a higher payment each month to take care of all that interest. The sooner you start making your payments, the lower is the amount of interest that you accrue, which means the lower is your monthly payment. And so you shouldn't be surprised that the payment that you have to make here is $2,386, which is about $12 per month less than you would have made in the situation where your first payment was going to be due 1 month from the time you got the mortgage. And so this is how you can solve for monthly payments, both for situations where payments are due 1 month from the time you take the loan, and also when the first payment is due on the exact same date as you take on the loan.